2 million VND per tael. That's the rapidly shrinking gap between Vietnam's SJC gold and the global market price, a significant financial shift directly impacting thousands of savvy investors and currency players right now. What's wild about this? While most of the financial world fixates on the latest tech stock movements or geopolitical tensions, these subtle yet powerful shifts in precious metals and currency markets are often where the real quiet money is made. This isn't just about gold. It's a direct indicator of capital flow and market sentiment, presenting unique arbitrage and investment opportunities for those who understand how to connect these dots. Ignore the mainstream noise for a moment, because this undercurrent could be your next profitable play, especially if you're looking beyond the obvious headlines for serious wealth generation. SJC gold prices are in a deep and sustained decline, directly leading to this narrowing premium over world gold. Simultaneously, we've seen the central USD exchange rate adjust slightly downwards, a dual movement observed just yesterday on August 19, 2026. This isn't simply a local economic footnote, it's a tangible reflection of broader market dynamics and investor behavior. For entrepreneurs and side hustlers, understanding these shifts is crucial. It impacts everything from the cost of international sourcing for your Amazon FBA business to the real value of your digital assets held in different currencies. When gold and USD rates move like this, it reshapes the economic environment, signaling potential weaknesses in one area, but also opening doors for shrewd business operators to capitalize on new pricing structures and arbitrage opportunities. Pay close attention. This is where agility pays off. Dan Tri, a prominent local source, reported yesterday, August 19, 2026, that SJC Gold's deep decline has pulled its premium over world gold down to nearly 2 million VND per tael. This isn't speculation. These are concrete, published figures indicating a significant repricing. Concurrently, the central USD exchange rate also adjusted slightly downwards, a key data point for anyone engaging in cross-border commerce or managing international finances. Think about it. These figures represent direct shifts in purchasing power and investment valuations, creating both risks for the unprepared and massive leverage for the informed. Whoever spotted this trend early, especially those with real-time data feeds, could already be adjusting their inventory buys or optimizing their currency hedges, capturing margins that traditional investors miss entirely. This data reveals a potent opportunity for strategic action. Here's what nobody mentions. While gold and USD rates are adjusting, it creates specific time-sensitive arbitrage windows or significant cost-saving opportunities for businesses dealing with international transactions or local precious metals. Who's already profiting from this trend? Savvy currency traders, businesses with flexible supply chains, and even individuals leveraging platforms like Shopify for global sales, optimizing their payment gateways. If you're running an Amazon FBA business sourcing products internationally, or a freelancing gig with clients paying in USD, these subtle currency shifts directly impact your bottom line. Today's actionable step: implement a real-time currency tracking tool like Wise or xe.com and explore automated rule-based trading platforms for gold or currency. Set up alerts for specific price points. This allows you to time your international payments or asset conversions, potentially saving or earning thousands in operational costs. Don't just watch the market move, make it move for you. Hit that subscribe button and join our community of entrepreneurs building smarter businesses. Leading economists and financial strategists are closely watching these currency and commodity shifts, especially the SJC gold realignment. Analysts at Bloomberg are noting a renewed focus on local market resilience, with some predicting this convergence will prompt domestic businesses to reevaluate their reliance on imported raw materials. Others see this as a signal for increased digital service exports, as a stronger local currency could make local talent more attractive globally. The consensus is split. Some view it as a necessary correction for long-term stability, while others highlight the short-term volatility as an arbitrage playground for astute traders. This is what many investors miss. The underlying sentiment shifts create new demand for niche financial advice. Across the globe, these localized currency realignments don't happen in a vacuum. Other markets, particularly those with significant trade ties to Southeast Asia, are already feeling the ripple effects. For instance, manufacturers sourcing components from the region might find their cost structures subtly altering, impacting their global competitiveness. Platforms like Alibaba and Amazon FBA sellers are recalibrating their pricing strategies for goods imported from these regions. It's a quiet reset, but it shifts the economic gravity slightly, opening doors for businesses that can adapt their supply chains or pivot their target markets to capitalize on new purchasing power dynamics. Think back to the early 2000s, when several emerging economies experienced similar periods of currency adjustments and commodity price normalization. What happened then? Businesses that focused on local production, efficient logistics, and digital distribution thrived. Those heavily reliant on fixed import-export margins struggled. For example, local SaaS companies that offered tools for inventory management or cross-border payment processing saw explosive growth. We're seeing echoes of that now. The agile, digitally native businesses are best positioned to navigate and profit from these market shifts, turning perceived weaknesses into strategic advantages by adapting their operational models. Who's winning and losing in this shifting economic landscape? Unexpectedly, many small-scale digital service providers are seeing a boost. Freelancers offering design, coding, or virtual assistant services via platforms like Upwork or Fiverr, especially those in regions with appreciating currencies, find their rates suddenly more competitive on the global stage. Conversely, traditional importers of luxury goods, who rely on a consistent currency spread, are feeling the pinch on their margins. But here's the twist. Even the losers create opportunities. Businesses offering cost optimization consulting or localized product alternatives are suddenly in high demand, turning a struggle into a service opportunity.